This episode is brought to you by Alphasense, the AI platform behind the world's biggest investment decisions. The right financial intelligence platform can make or break your quarter. Alphasense is the #1 rated financial research solution by G2. With AI search technology and a library of premium content, you can stay ahead of key macroeconomic trends and accelerate your investment research efforts. AI capabilities like smart synonyms and sentiment analysis provide even deeper industry and company analysis. Alphasense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it means a lot if you could rate, subscribe, review wherever you're watching or listening to it. Obviously, hoping for a 5-star rating. With me today, I'm happy to have on for, John, is it the third, fourth time? I can't remember, third or fourth time.
Third, yeah. It's been a number, and I enjoy each one.
Let's see. So we did a lot of it is MSG focus and Dolan focus, but we did some others. Anyway, I'm all over the place. John is a man of many talents. He runs all of the different Boyar things. They just launched the Boyar Substack, which I'll include a link to in the show notes. And I believe we'll have a link to this specific idea we're going to talk about in the show notes as well. So you can check the show notes for that. But before we get to the idea, just a quick disclaimer to remind everyone, nothing on this podcast is investing advice. Please do your own research, consult a financial advisor, all of that type of stuff. I always say that, but particularly in these markets, like, oh my God, nothing is financial advice because everything's going crazy. John, the stock we wanted to talk about today it's now MODG is the ticker. I believe they did MODG for its modern golf, but this is the company, people might know them as the old Callaway. They own Topgolf. It's a really interesting company, really interesting business, really interesting pitch. So I've said a lot. I'll just turn it over to you. Why is MODG so interesting right now?
Yeah, it's an extremely compelling story, and we've been following the name for quite some time. We've been following it actually, I think, since we were talking before, since 2009. Every year our research division, or we used to do a thematic piece. 2009, we decided to talk about stocks, consumer-related stocks that will do well, because at that point in time, no one wanted to own consumer-related names. So it's a name we know quite well. It's a really well-run company. A guy by the name of Chip Brewer actually was a guest on my podcast, runs it. He took it over in 2012 or 2013 and has done a fantastic job. And it's funny. The previous CEOs after Eli, the founder, died, were not golf enthusiasts. The last one was actually a tennis player, didn't even play golf. So that was part of the problem. Callaway or Topgolf was a huge pandemic beneficiary. Stock got up to about $37 and now is trading at 13 or so in change at a very low multiple. And it's really, to us, perplexing, because if you look at another name in the space, Acushnet, which we also have written favorably about, their stock charts are opposite each other. It's been just like this. And that leads us to believe that it's a Topgolf issue, not the equipment part of the business. Because if you look at the number of rounds played, et cetera, compared to pre-pandemic, this golf is only getting bigger and bigger. And I think right now the best way to play that is in shares of Modern Golf or Topgolf Callaway Brands.
Cool. No, that's a great overview. The one thing I'd add there is, the CEO being a golf enthusiast, it's a little too on the nose to have the CEO of a company who's a golf enthusiast, whose name is, I think it's actually his nickname, but be Chip, like just too on the nose. But, you said he's done a great job. And I do think the way they got Topgolf is they did an investment into them. I think they owned 14% back in like 2007. But the way they really got Topgolf is right when the pandemic hits, Topgolf goes into distress. And Callaway does a stock-for-stock merger. From memory, I think both sides get roughly 50% of the business, but they do a stock-for-stock merger, which in hindsight looks fantastic, right? You got a huge COVID beneficiary and you picked him up at distress levels right at the bottom. And I think part of that is your CEO is a golf enthusiast. He believes in the story. He believes in the name. He probably, I don't know if the tennis guy had still been in charge, if he would have done that. Maybe he would have bought pickleball instead. So maybe it would have been a wash. But I do want to, so let's dive in. I think you're right. I think the big question here is Topgolf, right? Callaway it's Modern Golf this year, they're forecasting about 635 million in consolidated EBITDA. Of that, 320 million roughly is Topgolf. So it's going to be 50% of the EBITDA. You can look at their projections. It is going to be more going forward. This is the growth story. They're putting in 190 million, if I remember correctly, of CapEx this year into Topgolf. This is what they're focused on. And as you said, the competitors are kind of up, they're down. So it's clearly Topgolf story. So let's just start high level. What do you think the market is worried about with Topgolf?
Well, it's about 13% of the shares are sold short. So, and you also have, Providence Equity Partners and some index funds owning a decent amount. So you get exaggerated moves. And this might be primed for a meme stock rally, given those factors. But I think the market is concerned that the average person spends $40 or so a year, and not a year, each time they go to a Topgolf. So it's not cheap. So if you go into a recession or a deeper recession, which people have been incorrectly calling for the last year and a half, that seems like something that would be the first to go, although people do seem to value experiences. But just going back to what you were talking a little bit more about, so Chip Brewer, he really cares about the game of golf. He wants it to grow. Obviously, his first and foremost, his fiduciary duty is to make sure Topgolf does well. But Topgolf is really helping grow the overall game of golf, which benefits the Callaway part of the business. So about 50-60% of the people who visit Topgolf have never played golf before. And about 10% of new players have said that they are going to play on a course have played on a course because they went to a Topgolf. So it's really growing the amount of golfers out there, which is fantastic. And if you go to, and they expect to add 3 to 4 million new off-course golf participants for every 11 new Topgolf venues. So every time you go to a Topgolf venue, it is plastered with Callaway branding, Travis Matthew branding, which is a brand that they own, and it will just really help the company create kind of one of these virtuous circles. So it really, really helps.
And now a quick break to remind you that this episode is brought to you exclusively by Alphasense, the AI platform behind the world's biggest investment decisions. Alphasense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS. So, I co-sign everything you said, but let me back up. I just realized, you and me, I'm rapidly approaching, you have kids, I'm rapidly approaching having kids. We are the target market for Topgolf. We obviously understand. Let's just back up a second. International listeners, people who might not, what is Topgolf? When you go to a Topgolf, what is it?
Yeah, that probably is how I should have started my.
I completely was going like everyone understood it. I golfed when I was a kid. I'm with you. We should have backed up to start.
So Topgolf, the company is a couple different divisions. So you have Topgolf, that they have an apparel division that owns things like Travis Matthews and Jack Wolfskin, which we can talk about Jack Wolfskin and potentially selling it later on if you'd like. That's something I think an activist could get involved in doing. Then you have the traditional ball business, which is a great business because if you play golf the way I play golf, you go through a lot of balls. So it's a recurring revenue business. And then you have clubs, and it's amazing what they put into these clubs. They literally have former NASA engineers designing these things. They put a lot of money into the clubs. And then you have something called Topgolf, which is primarily in the US. There's one in Mexico, there's a couple in Britain. But what it is basically a bowling alley meets a nightclub meets a driving range. You go there with your friends. You play these simulated games. It's a lot of fun. And 50-60% of the revenue is from food. As obviously a high margin. They have a decent sized corporate business. And you go there, and the average person goes 1.5 times a year, which they're trying to increase. And the average person spends about $40 or so when they go. And it's It's just a lot of fun. I think one of the things people are worried about, to go back to one of your other questions, is this a fad? Is this sustainable? And I have the owned and operated venues like right here, and you go from in 17, 40 to 80 something today, and they're growing same venue sales. I think they've more than demonstrated this is not a fad.
That is one of the questions I had. So let's just talk about the fad real quick. I worried a little bit about sustainability. Now, I live in New York City. I know you don't live here anymore, but you work here. We've met in the city before. I do think of something like Bullmore, right? Bullmore was really popular when I first moved to the city. And I think there's one, but Bullmore was basically like combo nightclub, good food, bowling lanes. And it was like filled every weekend. But then like kind of the novelty wore off. And yeah, it was probably filled on the weekends, but it's a big space. A Topgolf is a big space, and we'll talk the investment. They're filled Friday nights and Saturday nights. But you do kind of need the Sunday through Thursday crowd, at least to keep a little bit, to keep that fixed income. And what I worry is kind of the Bullmore thing. Yes, for 4 years, you've got enough demand that you can kind of keep this thing. But so one of my questions for that was, hey, you mentioned 2017 to 2000 to today, same store sales up. They've grown the business. But I do wonder, like the original batch of Topgolf stores, do we have any idea of how they're comping today? Like, have any of them close, or are any of them starting to experience distress? Because they do get a little older, they age. I was just kind of wondering that in terms of sustainability.
From what I've read, it's similar numbers to what is already out there. And yeah, I used to love to go into the Bullmore. It was like an Astor Place area, the Village. It was unbelievably expensive, but also you have to remember they had that in New York City. I can't imagine what the rent, or if they owned it, maybe it wasn't the highest and best use of that land, was to have something like that. So that might have been a one-off story, but the analogy I get.
Yeah. Let me ask, let's see, a few things. So I guess let's just talk returns, right? So they're going to build this Topgolf. And my first question, we'll dive into the numbers in a second, but I do wonder, a Topgolf, there is some brand there, right? But effectively what you've got is a big driving range with like 3 stories, a little bit of technology to track the balls and stuff. And I kind of wondered, hey, is this a land grab? Is it similar to a regional park, right? Where if I build the Topgolf outside of, I know there's one outside of Baton Rouge, just outside New Orleans. If I build that there, have I locked up the 6-hour radius around that? Or is this going to be, hey, I build one on one side of Baton Rouge, somebody else builds one on the other side, and you kind of are competing for all that land grab? Does that make sense?
Yeah, no, they have a Drive Shack is their main competitor. And these things are unbelievably expensive to build, somewhere between $20 and $50 million, depending on the size. They have like different locations. Could be a little off on the number, but I'm directionally correct. But they haven't built one since 2019. And Topgolf was going to open one up, or they were going to open one up in Phoenix. And Topgolf went in, and then they just stopped it. So Topgolf does have, like, you speak to people, they're like, oh, I love Topgolf. Like, the people who've been there love it. They have positive experiences. It's something that would be very hard to replicate. And I think it's something that scales. So they have a big, first mover advantage, and someone would have to spend a lot of money to go in and, to replicate it. And I wouldn't discount the technology. I mean, the Toptracer stuff is pretty impressive. I know there's Pac-Man and or whatever it's called, that's now on the PGA Tour, but the technology is pretty good.
Yeah, just on the kind of the fortressing a la regional theme park. You build a Six Flags outside of Detroit, there's never going to be another regional theme park built around there. One of the things that jumped out to me was, I think it was they did a Topgolf focus call in June, and they said, hey, of our 11 stores that we opened in 2022, 8 are performing above projections and 3 are performing, probably a little below projections. Not that they're a disaster, but below. And someone asked, what's the difference? And the guy said, oh, well, the 3 are the second stores in a market, whereas the 8 are in new markets. And they were saying, hey, we think when we opened a third store in a new market, second store in a new market, it might cannibalize a little bit. And to me, that was, it was a negative in terms of, yeah, you're probably not going to have 2 in New York City or 2 around Chicago or something, but it was actually a really big positive to me in terms of, you build one, you've kind of franchised that, you've kind of put the moat around that market and locked it up. So I was actually kind of positive on that. Let's talk I'll come back to the real estate in a second. I just want to, again, half the EBITDA is coming from Topgolf. The peers who have no EBITDA coming from Topgolf are straight up. The same store sales are continue to grow. Some people are a little worried about Q3, but they've reiterated their guidance. They put out 2025 targets, and they've consistently said, hey, we think we're going to hit them. We're actually above trend if you look at 2022 and 2023, where we're coming out. What do you think people are so worried about Topgolf?
I think it's just new. I also think you have growth investors are going into the stock, and they see some of this decelerating growth and they get spooked. And you also have to look, it's not a particularly well thought. I mean, there's a couple of sell side analysts. I mean, I know JP Morgan does, and the people at Jefferies actually do a really good job of covering them. But it's not a name. This is not a Magnificent Seven name. It's a Russell 2000 type company, and these small cap names have done awful, and I mean they've done much worse.
I do hear you on that. It is kind of surprising though, right? Because one of the things, it's easier to pitch something that the person is familiar with and likes. And, if I imagine your average portfolio manager, you come and you pitch them, hey, Topgolf and Callaway Golf, like that seems like it'd be easier to get in than your run of the mill, get in the portfolio, get a meeting, get them to spend time on it than your run of the mill industrial or something like that,
No, to me, the move down has been furious. It's, as I said, there's a big short position in there.
Well, there is a big short position, but they also have some convertible notes, if I remember correctly. So I bet part of the short is like hedging of the convert notes.
But the short position increased significantly over the last couple of months. So, and the note isn't like that the note was there. So there's something out there. The way I look at it is, also the CEO Brewer and the CFO keep buying stock personally. The board, I believe, a lot of the board members have elected to take their compensation in stock, which is a huge vote of confidence. So he's been a conservative guy. In his time there, he's made one big mistake, and overall has done a really good job. And I think he's sitting on something that could grow quite well. It's a show me story.
Just to add what you said, I'm just kind of glancing at the numbers. In June, a director buys $2 million of stock on the open market. I see 1, 2, 3, 4 purchases. If we include December, 5 purchases by the CEO, open market purchases of the stock. Combined, that's more than $1 million. The CFO's bought stock on the open market twice in the past year. The global CPO has bought $100,000 worth of stock. So there is a lot of insider buying, and all the insider buying was done significantly higher than today's price. Let me turn to the other pushback. Okay. So Topgolf economics, right? The company loves to come out and say our cash on cash returns at Topgolf are 50%. And guess what? It doesn't matter if your interest rates are 0, 5, or 10. If your cash on cash returns are 50%, you're going to do fine. But I do look at this, and I'm sorry to throw numbers out at people, but to make the numbers very simple, one of their 2022 reports, they said the adjusted EBITDA for Topgolf is, let's round it up to $6 million at a new location. And it costs $30 million to open up a Topgolf, right?
What?
So you just do 6 divided by 36. That's a 20% return, not 50%. And the way they get to 50% is with lots of financing and lots of construction financing stuff. And that's fine, right? Like retailers never include, when you hear a retailer say, hey, our new store is 30% payback, they're not talking about going and building a whole mall and putting their new store. It's just the cash return in there, right? But at the same time, I look at that and say, $30 million is a big chunk of change. And they're kind of only, I guess with interest rates going up, my question is, with interest rates going up, when I look at their cash on cash returns, it looks like they're assuming very low rents, very low vendor financing costs for that $22.5 million that they're financing. And I kind of wonder, hey, was this huge $30 million spend, was this kind of a function of you could make this work when interest rates were 0, but when interest rates are like 8% to do a construction loan, the returns drop really quickly?
I mean, the returns will drop, certainly. And listen, that's why you do your own homework and you don't rely on the really nice slide decks that Topgolf and all other companies provide. But the bottom line is they are profitable, they are growing. And if you take everything, you put a giant haircut there, it's still quite good. And it's interesting. We're debating back and forth internally because they talk about, they've been hinting that, oh, maybe they're going to start just doing the whole thing on their own and not have these REIT partners that they have. I don't know if they're posturing and trying to get better terms, or if the terms are just too onerous, or they just want to control their own destiny, which might also be the case. I mean, you look at these, the Home Depots of the world, all these great companies, Starbucks, they own or a lot of them, they own their own stores. So maybe that's what they want to do. I'm not sure. But the bottom line is, whether it's a 30%, 40% return, it's still a very, very good return, and something that they should be plowing their cash back into and reinvesting, because I think they have a long runway. And then they're going to have the high margin international. I mean, this is something that I think will do well internationally. It's always hard with culture and things like that. But that will be a high margin revenue stream. They think they can get to 250 venues outside of the United States.
What you're talking about is domestically, they're owning and operating all the Topgolfs. Obviously, they don't own all the real estate. We've talked about them, but internationally, it's high margin because they're planning to franchise the whole thing. And I think they've kind of said, hey, we can get, I don't have the exact numbers, but we think we can support 250 stores domestically. That's the exact number. Mm-hmm. And we think we could do the same internationally. So you think about 250 units, call it $5 million a unit. They get a, 5% royalty fee. Like, you could see how that could be really high margin. That could be quite profitable, lots of cash flow, and none of that's in any of the numbers currently.
It's in any of the numbers currently. And it has what we were talking about before, the added benefit. Not only are they going to, it'll be like, opening franchising a Burger King or a McDonald's. They get that high stream, but what they also get is exposure to Callaway clubs, Callaway balls, Travis Matthew. Like, it's free advertising for a lot of stuff that will also be quite valuable to them. So it's a great opportunity that no one is giving them credit for.
Let's dig into that. So obviously, modern golf, Callaway on one side, Topgolf on the other. You go to a Topgolf, you get the Callaway advertisements and all that sort of stuff. I think they would argue that's the synergy. Mm-hmm. My question is does it need to be together? Obviously these could be separated, but would it be better to separate these two? And then you could have the Callaway kind of direct Cushnet competitor. People could value that. And then you could have the Topgolf, completely separate, and Topgolf every 4 years, they could go and say, Callaway versus Titleist. Who wants to be our sponsor? Who wants to be the official clubs? Who wants to be the official balls? Would it make sense, or are there really synergies between having these two together? I guess is what I'm asking.
I think there's certainly synergies, because I think they're helping grow the game of golf, and then they have that first look into the consumers, or had Callaway in their minds who went to any of these Topgolf locations. What they can do is sell Jack Wolfskin and Travis Matthews for a fair amount of money. I mean, if you do it at like one-time sales, which is really low, you get $600-700 million, and they'll get a lot more than that for these businesses. And then you pay down the debt. You're able to spend more money in these high return Topgolf businesses. Or you buy back stock. I would much prefer that. And that's why I think, this is a stock where, listen, I don't think Chip deserves an activist, because I think he's done a good job. But I think to preempt an activist, or what an activist playbook would be to come in and sell the apparel business and use it to return capital to shareholders or reinvest in the business.
Yeah, look, I'm with you, especially the apparel business. It doesn't really fit here. I understand why. You can see the synergies between Callaway clubs are what people get introduced to the game of golf when they go to Topgolf for the first time. It's really hard for me to see the synergies of, hey, Jack Matthews is the golf shirt you get introduced to at the game of golf, so sell it. And then if you really believe the 30, 40, 50% returns on Topgolf, go build some more, go build them quicker with the proceeds, or buy back stock, whatever you need to do. But I'm with you. What else should we get? Oh, two other things. Just Topgolf, again, I'm very tickled by it. I've been to Topgolf a few times. I just want to talk about two things that maybe they don't impact the stock, but I was interesting. Number one, they formed a advertising partnership with Honda / Acura recently. And I thought that was really interesting. They came out and said, hey, Honda and Acura are big sponsors of the PGA Tour. They're going to be sponsors of ours. I don't know what exactly they're going to do with Topgolf, but I did wonder, like, a Topgolf has tens of thousands of people who are going to come through it every year. It's this huge thing. People are partying. I do wonder, you and I, you've been on talking about MSG Sphere before and MSG Garden. Obviously, you're not going to rebrand Topgolf into something else, but I wonder if you start having like the official energy drink of Topgolf, Topgolf Las Vegas, brought to you by insert sponsor here. Like, what's the type of advertising component? It's really interesting because it's just such a big space. You generally do get lots of advertisements attached to that.
Yeah, I don't. The answer is, I think it's a call option. I don't know. They have like a digital business as well, in the sense of like they have these games that people can play like remotely and all that kind. So maybe you put the advertising there. But yeah, you have people who are going there, having a good time, spending an hour and a half, 2 hours with positive associations to the place. Why not? And the places are very good looking and nice. Like, why not have other branding there?
I was almost wondering, like, so if you're familiar with the Topgolf, most of them have huge nets around. Yes. It's a big driving range with huge nets so that balls aren't going into the freeway or hitting random pedestrians. You could imagine, I haven't been to one in a few years, but you could imagine hanging advertisements from those huge nets, right? Both on the inside, so people are staring at them while they play, and on the outside, so when people are driving by, it's basically a billboard. Like, let me transition that hypothetical into something. They have talked about, this is a direct quote, we are still in the relatively early innings of maximizing the economics of Topgolf here. What else do you think they're talking about when they say they're maximizing the economics?
Well, they have this like pie system that they call
PEI,
it. Yep. Yeah. So the biggest complaint that people have when they go to Topgolf is the wait's too long. And obviously that's a problem that you can solve with money. And that's what they're doing. And they're, you pay $10 or $15, so you reserve your spot. And I think in some cases they even have a minimum time. I'm not 100% sure on that. And it's just making it much more efficient, where you don't have people sitting there for an hour doing nothing. It's just a much more efficient way of doing it. And that's driving significant, improvement in the business. So I think that's what they're largely referring to. Plus, as they build these things, every year they build 11, or they're trying to, they're learning more and more on how to build these well. And I think that just gets better with time.
Just going back to the PI system, PI, I think it's like player enhancement initiative. I can't remember, but you could imagine, they've said they're not going to do airline pricing, right? But you really could imagine airline pricing here, right? When does everybody want to go have the big Topgolf celebration? It's Friday night, it's Saturday night, it's bachelor parties, Saturday during the day, Sunday during the day. You could imagine, hey, you want a Friday night reservation? We've got one bay left. The normal bay goes for X dollars per hour. Friday night at 7, it's 7X per hour. And just put it up for bids for who wants it. Like, you could imagine a lot of revenue optimization. Now you have to weigh that against, hey, do you want to be the place that's charging $5,000 for a bay? Is that hitting your brand in some way, shape, or form? I'd argue at $5,000, I'd take it. But there's something there, and they're certainly in the very early innings of tapping that. And to our point earlier on kind of usage during the week, they've got half off Tuesdays. I went and looked at the New Jersey one. They've got, hey, come on Wednesday and we'll give you like $20 of wings or something. Like, there's other things they can do, not just on incremental pricing at peak times, but probably decreasing pricing to get leverage on, the Topgolf is there, get leverage and optimization in the kind of dollar hours.
Yeah, no, exactly. And they also were, I think in some of them you can have golf lessons and like other things that you just do to get people in there. It just makes a lot of sense. I think this is one of the names, type of name that if you're patient and you can stand this short-term pain, which it's been painful, you can make a fair amount of money.
We're going to talk some of the parts in 1 second, but I do just want to ask one last question here. Sure. Again, this is very nerdy, but one of the things they mentioned is the CEO of Topgolf, or I guess he's the president of Topgolf, came and said, hey, our KPI, the performance indicator we track the most, is number of balls hit. And they said, hey, we want to have what is it, 5 billion balls hit by 2025 or something. And I thought that was really interesting because I can see what they're saying, right? More balls hit means more people in there. They're hitting more balls. But at the same time, I'm sure both you and I are the same. We've texted about some of the John Malone stuff before. We really track incentives and comp. And I just wonder, like, if balls hit is your KPI, you might not want balls hit, right? Like, I could imagine you and I going, and if we hit 100 balls in an hour, I could imagine how that could be a lot less profitable for them than if you and I hit 50 balls in an hour. But, we bought 2 beers, we had a burger, we were hanging out, all that type of stuff. Like, is balls hit really the KPI? Do you worry that that's like suboptimal management?
Yeah, no, that's a really interesting question. Yeah, is it the best one? No, but you also, one of the things they're trying to do is have these double bays. So if you can get a whole bunch of people there who, if you can go with 3 or 4, 6 or 7 of your friends take up 2 bays, and you're eating and drinking, and you're going up every 3 or 4 minutes to hit that, I guess would work out well. But yeah, no, they want you to sit there and eat and order booze and have wings, etc. So they don't want you sitting there just hitting the ball. But like, hitting the ball is the fun part and what gets people there.
You mentioned the double base out there. Like, one of the things I love about Topgolf from a just thinking about a perspective is double bays. I mean, what they're saying is bachelor parties, bachelorette parties, birthday parties. Like, that's a double bay, right? You and 10 friends go and rent. But double bays and corporate events. If you just think about Topgolf, like, there just aren't a lot of brand safe things that you as a corporate can go and say, hey, we're going to take a team of 15 people to do. Literally everyone can have a good time. Like, even if you're not a golfer, you can get up there. They've got chipping games that you can play that you have no skills, or you can just sit in the back and drink. And there's like lots of other fun stuff to do. And it just strikes me like these bays that are it's so brand safe, and it's got such brand, like, it just does feel like there's a niche for it, and you build it. And as we talked about earlier, nobody else is building anything similar anywhere around you. It feels like there's a really nice niche in there for it. And, what are people going to want to do 15 years from now? Probably play golf, go outside, have corporate events that are brand safe. Like, it's tough to see the demand for that going away.
Yeah, I agree. I mean, the negative or what could go wrong is Topgolf is a fad, and, work from home, totally reverses, and people are playing a lot less golf. Both of which I do not think is going to, occur.
We could talk like golf. I do think they've got a chart in one of their investor slides. I don't have it, but it does show until like 16 or 17, golf, maybe even until the pandemic, golf was kind of on the actual golf courses, it was experiencing a decline. And I do remember old Wall Street Journal articles about the aging of golf. Part of that might have been Tiger was kind of aging out, and Tiger brought so many people. Like, one superstar in a sport can bring a lot of people in. Tiger was kind of aging out. And then you have COVID, and golf is a huge beneficiary, right? Like, it's one of the few things you can do. And I could see people worrying like, hey, does golf revert back to that pre-COVID trend? But the other nice thing about that chart is it shows like kind of the top golf on top of it, and you've got so many people. And I don't think you need to love golf to be part of the Topgolf thing. I don't know. I definitely hear you on that, but it's strange.
Yeah, and rounds played this year was higher than last year. I mean, there was a slight bump between 20. There was a slight decrease from the year before, but it's going in the right direction. I don't think that this is a fad, and I think as I said, they're building the funnel.
Let me add, so let's talk some of the parts real quick, right? As you and I are talking, the stock is at $12 or $13 or something. They've guided to, as we talked about, $635 million in EBITDA this year, with about half of that coming from Topgolf. Now, we don't have to get into how they're, there is a little bit of funky accounting from the financing leases and the Topgolf and everything, but just high level, you've got this growth kind of capital intensive business in Topgolf that's coming up. And then you've got the brands, and then you've got the golf clubs. And, both the brands and the golf clubs probably deserve a little bit different multiple. They take different, they take different amounts of CapEx, but those are pretty much like lower growth, especially the golf clubs, like long history of profitability. So how do you model and value this?
For the club business?
But just the sum of the parts of the whole thing.
Oh, yeah. I mean, you can The apparel, we do it 10 times. We go out to 2025. We did 10 times for the apparel, 12 times for the golf equipment, and 15 times for Topgolf. And you can quibble with, is 15 too aggressive? But for a fast growing entertainment-like concept, maybe not. So even if you put it to 12 or 13 times, you still have a much higher stock than you do now. I mean, this is something where you can, it could be, I'm not saying it will be, it could be a triple from here.
Can you walk me through, you listed 3 multiples, and those are all EBITDA multiples, if I remember the report, yes. And I'm just doing the math in my head correctly. But let's just walk through the closest comps, right? For the golf clubs, which you valued at 12x EBITDA. Like where's that multiple coming from?
That's looking at, there's been a lot of transactions in the golf equipment space. And we always use, when we can, precedent industry transactions. I don't have which ones off the top of my head, but there's been a few over the last couple of years. So those are fresh comps, and not much higher than probably what Acushnet is trading for right now.
If I remember correctly from your report, and I do remember, TaylorMade was one of the big comps you did, which transacted in 2021 for about 15 times EBITDA. So you're at 12, 15 times EBITDA is kind of the takeout multiple. That makes sense. Was Acushnet who bought TaylorMade? I can't remember.
No, who bought them? Don't remember, but
yeah, I can't. But I think 12x is probably fine, because golf equipment like Callaway, as you said, you're not going to. If you think about a golf club, like, there is NASA engineering going into that. These are deep, long-seated brands. Like, these are very brandy businesses. Now, if you were forecasting golf to go into terminal decline or something like that, we could have a discussion. But you and I are not going to go start up a golf club business tomorrow. It's very hard. They're very moaty. They've got brands. They've got engineers. There's a lot of returns to scale there. Like, that 12 times EBITDA, pretty stable business. Maybe you could say 10 if you want, but I don't think this is like a 4 times EBITDA business. Like, this is a solid business. Let's go to apparel.
And also remember, you also have the golf balls in there.
Yep.
Going back to someone like me who loses kind of golf balls.
Though, balls are probably balls you do get. Like, I do remember the Titleist Pro V1s when I was growing up. Like, everybody when I was golfing was, Titleist Pro V1s. Like, you do have brand and you do have margin there, but balls, not quite the same amount of engineering. There are.
No, I meant the replacement part of it. So you get a.
I just meant that's a lower margin, lower moaty business.
Yeah.
You can always substitute there, but the clubs, and
the clubs are tough. Plus, you need sponsorships as well.
Sponsorships, and the club it's an investment, right? If you're a golfer, the clubs are your thing. It's just very tough to go knock off clubs. Apparel, which is the smallest part of the business, you value at 10 times. We don't need to talk about that too much, but I don't think 10 times EBITDA for an apparel business is crazy.
No, and as I said, I think they should get rid of it, or at least part of it. I think the stock would go significantly higher.
And then the last one is you threw 15 times EBITDA out for Topgolf. And obviously you're using a 2025 multiple. Topgolf is growing quickly. We mentioned they're launching 11 stores last year, 11 stores this year. And I mean, this is off of a base that's approaching 100. So this is fast growing, a lot of CapEx going into this. Ignoring the growth and everything, they've got the returns. I don't think EBITDA, as long as the business is in a fad, is crazy, but where's the 15 times coming from?
Just looking at other fast-growing entertainment concepts. I don't have which ones we did. We did the report in February off the top of my head, but some people in the street are modeling it at 13 times. We have 15. Maybe that's a bit aggressive or rich. As I said, even if you do it at 14 or 13, you're going to make a lot of money here. So it's, and I just think the international runway is huge. The Toptracer part of the business, which we didn't discuss, maybe I'll briefly
go for it.
Talk about it. So you Toptracer, when you go to a range or to a Topgolf, it tracks the flight of your balls. It's pretty interesting. And what they're doing, and they're in early innings of it, is going to driving ranges and country clubs and saying, this would be good for your customers, and they can show that you get a big uplift in revenue. And for $2,000 a year in per bay, we will allow you to let your customers see how far they hit the ball and all sorts of other statistics. I have no idea what people do with, but they like. it's been very successful. They have a couple of competitors, but they are the leader in it. So that's a fast growing, high margin, recurring revenue type of business. So, those are all the things that got us to give it a premium multiple. As I said, you can quibble with. It's only a small part of the top story. I think it's only 5%.
On Toptracer, if I remember correctly, they go and it's 2,000 a year for a driver.
2,000 a year per bay.
And I think what they show is, hey, you spend 2,000 a year on this, but your customers, because they enjoy it, right? It's something that gives them more data, more info. They're going to hit. I can't remember the exact number, but it causes them to hit more balls. So yes, it's a 2,000 a year investment, but your revenue goes up, 4,000 a year when you buy this. Plus, people are on the range longer, so you probably get knock-on effects of buying a couple more drinks or stuff like that. So I that's the pitch, if I remember correctly.
Yeah, and you probably, I don't know if they're there yet, but they're getting all this data on people's swings and things like that. They probably can use it to help sell more clubs and say, oh, you're swinging this way, so you should buy this club, which would be helpful for pro shops, etc.
And now a quick break to remind you that this episode is brought to you exclusively by Alphasense, the AI platform behind the world's biggest investment decisions. Alphasense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS. I think we've hit the high levels. Like most of the time we spent was talking about Topgolf, which is probably right, because again, it's half the earnings here. It is the reason peers are up, these guys are down. You have to imagine it's because peers don't have a Topgolf and the market's worried about something with Topgolf. Listen to an earnings call every time. Like every question is, what are the up-to-date Topgolf trends? Like people are obviously worried about that. We covered that. We covered the insider buying. We covered the share buybacks briefly. We covered golf's not going away, all that sort of stuff. So I just want to ask you, we've covered a lot. The stock it's just been hammered this year, right? It's been hammered. A lot of small cap stuff has been hammered. But is there anything else? I think we hit the main worry, Topgolf. But is there anything else here that kind of keeps you up at night with this, that you think the market might be worried about, that either you're worried about, you're thinking about, or you think the market's too concerned with?
One of the reasons the stock went down earlier this year, and I don't even think that management should have said it. That they were saying that demand for the events business was going down, and they were blaming the banking crisis, which I don't think someone canceled the party because of the banking crisis. But
Silicon Valley Bank and
unless they were a big but I don't think they were a big customer. All the problems that they seem to be having are shorter term in nature, and you know us pretty well. We're not quarter to quarter type of investors. Obviously, it'd be better to do these things at the lowest price possible. But I think the story's there, and people who are patient should continue and use this opportunity as a gift to you're able to buy double the amount of shares than you were a year ago or so. It's a really compelling story that obviously there's risk with everything. There's leverage, but there are ways to get that leverage down. And yet you have good management who is highly incentivized to make this work.
Yeah, the thing I really like here is Topgolf is a very unique concept. Just off the top of my head, I can't really think of a concept like it on the public markets. I'm sure there is, but I can't think of any off the top of my head that are kind of akin to this. $30 million huge investment upfront to create entertainment venues, and I just hey, you're buying this at. I don't remember what they merged in late 2020, so the valuation metrics were all over the place. But the business is much more proved out. It's much bigger now. And, is Topgolf, if Topgolf is worth 15 times EBITDA, that would be worth all of today's share price. And then you would get the other businesses thrown in for free. And, I just look at that and I say, that's a pretty attractive combo. And I don't know, it seems like the market's forecasting a lot of Topgolf fears that I certainly don't have, or I think are very remote and tail risky.
Yeah. Listen, there's risk in everything that you do, except if you're going to, short duration treasuries.
I thought you were going to say just treasuries in general. I'm going to be like Silicon Valley Bank and First Republic pulled you wrong there.
That's why I said true. That's why I said short duration. But if you're going to take a risk, this is one where we have a high conviction on, and that's why I wanted to tell the story out there, because it's just unbelievable. And I think this is one where, as I said, I think Chip Brewer has done a great job, but maybe he should think about selling the apparel business.
It's kind of what I was dancing around here. The activist playbook, as you said, it writes itself. I mean, you mentioned selling the apparel business, which would probably be worth $500 million to $1 billion, depending on kind of what you think with the carve out costs and everything, which that would be a lot, right? If this is a $2.5 billion market cap company, that would be a lot. You could pay down a lot of debt. You could fund a lot of Topgolfs with that. But to me, the activist playbook would be a step further. Break every, I understand they think there's synergies between Callaway and Topgolf, but I think the activist playbook is break every single part apart, right? Like TaylorMade and Cushnet both have a history of being owned by private equity. Sell Callaway to private equity who wants to invest in this good revenue stream, very stable, maybe a little economically sensitive, but you kind of know what you're getting. Sell it to them, let them slap a lot of leverage on it. Sell the brands to either strategic or private equity, and then put Topgolf as a pure play Topgolf subsidiary on the public markets and let growth investors kind of go after that. And that's the activist playbook to me. And I think you see a stock a lot higher if somebody comes in and drives that. You get that higher quicker, or if Topgolf plays out, you'll get the higher over a longer time frame from Topgolf playing out as is.
That could work too. I think I do think there are synergies in between the two. I don't see that with the apparel at all. But your way works too. I think either way, we should make money.
Like it. Cool. Anything else you want to chat about here?
No, I think we've, when we were talking before, you said, before, a couple of days ago when we were speaking of, 55 minutes, flies by, and you're certainly right. I looked at the clock now and I can't believe how long we were speaking. So thank you for being on. It was a lot of fun, and hopefully people find this to be useful.
All right. Last question before I let you go. Are you excited for the Knicks and Rangers this year?
Listen, after the excitement of last year, it was so cool having, the Knicks just, make the playoffs. And it was just fun.
Make the play. This is 3 years in the row in the playoffs, John.
Yeah, but they went far in. It was great. And I'm trying to convince my wife to go out to the Vegas for the Sphere, to see U2. And from what I understand, the rumors are that the next, we're talking about the MSG Sphere, the next act that they're going to sign or they're going to announce is Fish, which makes a ton of sense. And that's been a fun one to watch.
The Sphere, you and I, did we do an episode on that? I think I did it with Chris McIntyre, but we talked MSG Entertainment and we mentioned the Sphere then.
We talked all things Dolan. Yeah.
Well, that will be its own podcast for another day. That is one of the most interesting one out there, because Topgolf, you talk N of one, Sphere is legit N of one. There is nothing else. The closest thing to Sphere on the public markets is MSG Entertainment, which owns the Garden. That's the only other publicly traded arena. But Sphere to Garden is, it's not apples to oranges. It's apples to basketballs or something. It's completely different.
When you look at those pictures in Vegas and the advertising opportunities outside of that stadium is just enormous. I wrote a lengthy opening letter to James Dole in 2019 saying, stop construction of the Sphere. I wish it was never built. It was, $2.2 billion of shareholder money that should never have been spent. But now that it's there, let's at least embrace it. I think it could, maybe he's right. Maybe this will do well. And I just hope that if it does well, that he does this in a capital light way going forward instead of building these things.
Talking about international franchising, the international franchise of the Sphere. No, look, all right, we'll wrap it up in 2 minutes. My two worries with the Sphere are, as you said, it seems pretty clear they want to do more. And I've never heard of a franchised arena business. I understand there's some tech behind this, but a franchise arena business is very strange, and the economics behind it, I've never heard of it. It would be new, and I worry he's going to go build one. And then the second thing is, okay, the Sphere, I still don't think the $2.2 billion is going to be a good return, but you know what? That doesn't matter from today's standpoint. What I worry about with the Sphere right now is the reviews are unbelievable as is, right? But I worry about that thing where your first reviews, you blow it out, right? YouTube, all costs, no expenses spared. It's so novel having this eyeball in. They're going to have F1 in a few months and it's going to be great. I worry a year from now, like, who's after U2 and Fish, right? Like, how do you keep filling the stadium up? And I worry Taylor would be, I mean, she'd be unbelievable, but there aren't a ton of bands who could fill like this 20,000 seat stadium who can fill it 20 times a week. The live experience show that they show, it seems awesome, but how many times can you fill that up? Like, I just worry a year from now, people are like, oh, they're having a lot of trouble filling that thing. And, you know, the eyeball is really novel when you throw it for the first time. But, you know, a year from now, all the residents like this giant blue eyeball keeps shining. I hate that thing. And, you know, I do think there's an advertising case there, but I just worry about the sustainability of the economics there.
What I had said in that letter was you have the best business in the world, or one of the best businesses in the world, in owning Madison Square Garden, having the lease in the Beacon Theater. Stick with that and, you know, renovate that every 15 or 20 years. The Sphere is speculative, and, you know, position yourself accordingly.
At least you got it out of the corporate overhead. Anyway, John, this was great. Looking forward to having you back. I think it's going to be the fifth time the next time you come on. You know, fifth time.
Do I get a hat?
No, well, you should have gotten a hat for the second time. I think I got the hats recently. We'll get you a hat, but the fifth time, there is, some of the guests are starting to hit it. There is a special guest for the fifth time, so we'll look forward to that as well.
Sounds good. Thank you so much for having me, and good luck with everything. And
of course, links to all of John's Substacks and everything will be in the show notes for people. And I appreciate the well wishes, John. We'll talk soon.
Thank you.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.